Vinati Saraf, ED at Vinati Organics, joins in for a deeper understanding of how business is shaping up. Vinati, great to have you on the show. Let's start off with the two macro trends. Oil prices have risen 15% this year, while the rupee has depreciated 12% year to date. I mean, you saw the headlines just about a few minutes back where the currency's gone now closer towards 72.50. We're still about maybe a few points off, but even so, what's the sensitivity of these two variables on your cost and earnings?
See, we are mostly an export-oriented company. About 80% of our revenues come from US dollars. Now, to hedge that, our raw materials are also priced in USD, even the ones that we are importing, as well as the ones we source locally. Excuse me, even the ones that we source locally take into account the exchange rate parity. Hence, as a result, we are about 25% of our overall revenues are exposed to the exchange rate fluctuation. So if the rupee over 6 months has depreciated about 10-11%, the overall impact on our sales would be about 2 to 3% in a positive way for us. As far as the crude oil price increase goes, our raw materials come from refineries, hence they are dependent on crude prices. But we are able to pass through the price increase in our sales prices, as we have a formula-based pricing system. So every month as our input prices change based on crude, so do our sales prices.
How exactly a weak rupee translate into better earnings for you? Are you hedged, and because of this hedging nothing happens this quarter but benefits would come next quarter? Or when you go and renegotiate your contracts with your buyers, do they give you that rupee benefit, or you also have to share or pass on some of the rupee benefit to them?
No. So as of now in our contracts, our pricing contracts, there is no clause for exchange rate, and the reason for that is in our contracts even the raw materials are taken in US dollars. So what is our net exposure to the exchange rate is just the sales price minus the cost, which is the additional surplus. Now even that we actually hedge it based on inflation of compared to vis-a-vis the overall inflation. So the rupee depreciation over a long run has a positive impact on our revenues and profitability.
Could you also broadly tell me, do you have you've shared with us that you are a largely export driven company, but is there an overlap of some important imported materials which you need to use and which you process it and then you have to export it? I'm just trying to understand the entire supply chain.
See, our major raw materials either are imported or they are sourced locally from refineries. So even the raw materials that are sourced locally, their price changes every month based on the US dollar price of the same raw material, based on the imported price. So it's safe to say that all our raw materials are also denominated in dollars. So that provides a natural hedge to at least 50% of our revenues.
Let's talk about the business micros then, because Lubrizol boosted your ATBS price and demand for your product as well. From the 45% global market share, what do you see this rising to? And will Q1 prices then extend through the year, and has expanded capacity been commissioned?
See, in ATBS in the beginning of 2018, our largest competitor exited the industry altogether. So as a result of which, our overall market share for ATBS has increased from 45% to 65% globally. Now we expect this to be maintained and this trend to continue, because there's no new significant player coming in the market, simply because it's a very difficult product to make. The technology is scarce and very difficult to source. So going forward, one can expect similar performance as you would see in Q4 of FY18 and Q1 of FY19.
Revenues are expected to moderate in Q2 due to BASF plant shutdown. What's the extent of Q-on-Q moderation and the impact thereof?
See, IBB as of now accounts for a little less than 20% of our overall revenues. Yes, in Q2 there will be an impact because of the shutdown, but we think they will make up for it, or we will make up for it once their plant is up and running, and hence Q3 and Q4 will make up for it. So for the overall year in FY19, you wouldn't see much difference in sales compared to FY18 for IBB.
Okay, so let's understand about the other growth catalysts like the launch of butylated phenols, contribution seen from custom products which enjoy higher margin. How do you see the entire product portfolio actually shape up in the next few quarters?
See, butyl phenols we'll be making 4 types of butylated phenols, all derivatives of isobutylene. Some of these compounds are presently imported into India, so we are going for import substitution. They will be catering to industries such as agrochemicals, resins, plastics, etc. The plant is expected to come on stream by April 2019. For FY20, we are taking about 65-70% capacity utilization, which will result in revenues of about 250 crores. And then in FY21, if you go for 95% capacity utilization, you're looking at overall revenues of 350 to 400 crores coming from butyl phenols alone.
Now, Vinati, just to get closing comments, you have a capex plan in place and you also have plans to make the company zero debt. How exactly would you be funding your capex? Because if the ambition is to expand the capacity and also reduce the total debt level down, are you banking on some asset sale? Are you banking on some serious improvement in cash flow? How will it tie together?
See, as of now, we are a zero debt company already. Our annual EBITDA margins are somewhere about 35%. So you're talking of annual cash flow of about 250 crores or so. We already have about 140 crores in our treasury. The capex plan for this year, including butyl phenols, as well as the second major capex, will be the ATBS expansion, where we are expanding the capacity from 26,000 to 40,000, which will be another 100 crores. So the total capex this year to the tune of 300 crores would be funded easily by our internal accruals itself. So there's no plan on taking on debt or any asset sale, because we are a cash flow positive company, and we will remain so even after these capex.
Okay. Vinati, good luck. Thank you for joining us. Well, the bond yields have gone to 8.1%.